Everyone thinks successful companies build one mega brand and defend it forever. Procter & Gamble proved the opposite, and it changed business forever. When William Procter and James Gamble merged their soap businesses in Cincinnati in 1837, they had no idea they were laying the foundation for a radically different approach to growth. For decades, P&G operated like most companies: one brand, one product line, expand cautiously. But by the early 1900s, something shifted. The company made a decision that seemed almost reckless at the time. They would deliberately create competing brands, selling similar products under different names to different customer segments in the same store. Ivory soap had already become P&G's flagship. It was pure, it floated, it had a story. But instead of milking that success, P&G launched Camay, a competitor positioned as more luxurious, more feminine. Then came Lava soap for mechanics, Zest for the budget-conscious. The strategy baffled retailers and analysts. Why would a company cannibalize its own sales? The answer reveals something fundamental about how modern brands actually scale. P&G understood something that most competitors missed. Different customers have different needs, and they'll pay different prices for different solutions. By owning multiple brands in the same category, P&G captured shelf space, captured market share, and captured different income levels all at once. A family might buy Ivory for everyday use, Camay for special occasions, and Lava when needed. P&G won 3 times over. This portfolio strategy extended far beyond soap. By the 1950s, P&G owned Tide, which would become the dominant laundry detergent. But they also owned Cheer, Duz, Dreft, and Oxidol. Each was engineered for a slightly different water temperature, fabric type, or price point. The company's marketing spend wasn't divided equally, it was strategic. The biggest budgets went to brands with the widest appeal and highest margins. What made this approach economically viable was advertising. P&G became obsessed with advertising spend, not because they wanted to, but because the strategy demanded it. Each brand needed its own identity, its own story, its own reason to exist in the consumer's mind. Tide wasn't just detergent, it was power. Cheer was gentleness. Dreft was for delicate fabrics. The messaging had to be distinct, consistent, and everywhere. By the 1970s and 1980, P&G's advertising budget had become legendary, sometimes exceeding 10% of revenue. That's an enormous commitment. But the company had learned that brand awareness and brand differentiation were worth the expense. Television was the new battleground. Whoever controlled prime time controlled the market. P&G sponsored soap operas, game shows, evening dramas. The term soap opera itself originated from P&G's sponsorship model. The portfolio expanded across categories: Crest toothpaste, Pampers diapers, Folgers coffee, Head & Shoulders shampoo. P&G didn't just enter these markets, it dominated them. And in each category, the same pattern repeated: multiple brands, differentiated positioning, aggressive marketing budgets. By the 1990s, P&G owned dozens of household names, each with its own marketing infrastructure, its own advertising agency relationships, its own consumer research operation. But this model created a hidden complexity. Managing dozens of brands meant managing dozens of profit centers, dozens of supply chains, dozens of marketing strategies. The organizational cost was substantial. P&G had to develop sophisticated systems to allocate marketing, spend across brands, measure return on investment per brand, and prevent internal competition from becoming destructive. They essentially invented modern brand management accounting. Strategy worked for decades. P&G's revenue and profit grew consistently. The company became a blue-chip darling, a model for how to build enduring competitive advantage. But the economics of marketing spend began to shift in the 2000s. Television audiences fragmented. Digital advertising emerged. The cost of reaching consumers changed. The model that had worked so brilliantly in the era of 3 television networks suddenly faced new pressures. P&G adapted. The company consolidated brands, divested underperformers, and shifted marketing budgets toward digital channels. But the core insight remained: owning multiple brands in the same category, each with distinct positioning and price point, was a defensible strategy. The company's portfolio approach had become its structural advantage. Competitors had tried to replicate it, but few had the capital, the organizational discipline, or the brand-building expertise to execute it at scale. Today, P&G's portfolio spans over 65 brands across 10 product categories. The company still spends billions on marketing annually, though the breakdown has shifted. Digital advertising, influencer partnerships, and direct consumer engagement have supplemented traditional media, but the underlying philosophy hasn't changed. Own the shelf, own the consumer's mind, own the category. Different brands for different needs, different prices, different occasions. What P&G demonstrated over nearly 2 centuries was that brand success isn't about building one unbeatable product. It's about understanding market segmentation, consumer psychology, and the economics of shelf space and advertising reach. By fragmenting the market themselves, rather than letting competitors do it, P&G maintained control. That strategic choice, made over a century ago, shaped how modern consumer goods companies think about growth, marketing spend, and competitive positioning. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover the hidden strategic decisions that built the world's most enduring brands. There's a new business origin story every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.